Good day, fellow investors.
Pernod Ricard and Diageo have been two very requested stocks for me to analyze. And what I want to discuss is that despite the stock price drops, I want to give you 4 investing factors that you can also apply to your future analysis that will show you how these stocks are still very risky for a low reward from an investment perspective. The question here was, are those similar to Nestlé that we analyzed recently? And the answer is yes. Let's dig deeper. Pernod Ricard did very well over the last 20 years on the boom, on the higher demand for such products, but the last year and a half it has been down 41% from the peak, and that is a big decline. The market cap is now 31 billion euros, P ratio 21, and dividend yield 3.76. Let's look at the fundamentals, at the details, and they say there is a robust performance in a normalizing spirits market. But that is what happens with stocks always. After a boom, organic net sales are down and the valuation also contracts, as we will see. Now, if I look at the numbers, you say, Sven, it is not that expensive. The EPS is 8. I compare it to the stock price, that's 15, then a P ratio. But why does Google say the P ratio is 21 and not 15? Well, we always need to read the details, and you see earnings per share. And here you see a little number note that says that these are only used with recurring items. And this is what gets me pissed already. Recurring, like we bought something, it was a total mistake, we canceled 2 billion euros of goodwill, and that doesn't affect our earnings. We do that every year. And those cancellations are non-recurring. Be careful for that when it comes to investing. And then we see, okay, normalization, weakness across the board. Okay, nothing wrong there. But if we look at what was the boom, of course, pandemic and spirits were in vigor again. And now we have this slow, let's say, cooling off. And again, going for capital allocation, discussing capital allocation, active portfolio management, disposals, then they buy something again. When you dispose something, you don't dispose it because it's doing great, thus the price you're getting is low, but then you go acquire new things and try to improve that gross margin because the management is likely rewarded on gross margin. And you can see here they just show the pro margin instead of the real margin, organic and real reported. So there is always this difference between organic and reported. The reported is what matters. And no matter what Lewis Hamilton here thinks or drinks, but all these new things, new products also lead to increased competitiveness and cannibalization. And this is something very important because I see around my neighbor is doing his own gin, tequila, kombucha, whatever. So it's not like the strength of the brands is really there. People are testing other things, and that's same as Nestlé, same as this, let's say, old brand companies. Things are moving, things are coming in, and they need to constantly add new brands, buy them sometimes for a pricey tag, sell the ones that are not doing, and that comes constantly as non-recurring but are recurring costs. And yes, they are working on the value creation there. Their target is for ambition is for growth, but we don't know if that will happen. The capital allocation priorities, future organic growth, okay, but this including value creating M&A, that's always a big question. We see in the non-recurring charges, it's not always working. Okay, the dividend is there, constantly growing, and share buyback when above priorities are fulfilled. The outlook is, okay, they always need to say growth, 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 and then you get to the first quarter and you say we'll grow for the year, but the first quarter will be soft, and then you get to the real numbers. This was released yesterday, I think. Decline of 5-6%, and then again a different number reported. And that's a big decline. That's not just normalization, that's a trend that might not really be just there from normalization. And we see across the board with this good, let's say, historical brands. And we expect full year organic net sales to grow, but we will see whether that will happen, and that is a big risk also for investments. Then I again look at the net profit, and it is down significantly, 30-40%. And I look at something even more important, liabilities. So we see the debt has gone from 9.6 billion to 10.9 billion in 1 year. So the debt has increased by 1.3 billion, and there is significant debt there that has been piled and piled over the last few years, with then what we see now, a declining market. And here we have to discuss competition. There is a lot of competition. There are many of these new brands coming up. You can acquire them, but there are constantly new ones coming out, which then leads to the question of capital allocation. Normalization, yes, but we don't know how long the normalization will last, and the previous stock exuberance is what we need to discuss. And if I look at the long-term debt, 6.5 billion, and now we are at almost 11. So 5 billion of debt has been added for no value created. If I look at it from 2019, the stock is down, net income is... That is also something that we have to discuss when it comes to the management incentives these days. Are they incentivized to do more M&As? Do they get fees, extra charges, more works, more power, more this for just adding brands, selling other things with investment bankers? It's all this area of things where a real business owner would not go into. He would just stick to his business, cash flow, profitability, and that is something that is plaguing the whole management environment in Europe, in the US. Pension funds are owning these businesses, and there is simply not that connection with the real ownership that is there with the smaller brands that are growing and taking the market share. That's something that is there. It's very hard to find the owner, the founder that grew these businesses, and that mentality is unfortunately gone. And the normalization part, if you are from Europe, you see it around. People are not spending as they were spending in 2022, 2023, 2021. There was this boom, and now it's just, yes, normalized. But if this is normal, then we cannot expect the growth rates from earlier to replicate. We have to expect stagnating revenues and profits. Which leads then to the stock price exuberance boom and valuation. Because here in May, the valuation was much higher, earnings were a little bit higher, earnings per share were 7, P ratio 30, the stock price hit 200 and more in May 23. Now, earnings per share are a little bit lower, EPS 5, P ratio 20, and that would give a stock price of 100. That's explaining the crash here of 50%. I think that this would be fairly priced now at a P ratio of 12, which then leads to a price of 60. Call me crazy, but that's another 50% down. That would maybe make it a value investor, fairly valued for an owner for an acquisition. If I put this into the value investing quadrant, I have put it here with Nestle. Yes, it will be likely a 5%. Private equity funds are buying at 10%, and that is the long-term, let's say, margin of safety with these businesses. Yes, the brands are there, everything, but is still risky even if the price is lower. It's not a value investment opportunities, and we have discussed better value investment opportunities at these levels, at these prices, some with more risk, AI risk, business risk, but there is better in the market. Let's go to Diageo. Bigger market cap, P ratio equal, dividend yield equal, and also the stock price is down. So volatile operating environment, similar, these are big diversified businesses. Free cash flow 2.6 billion. If I put that into a perspective of the market capitalization, that's a 3% free cash flow yield, which means the whole free cash flow is used for the dividend and nothing is left. Decline in EPS due to softer operating profit and higher finance charges. This also means that they have piled up debt over time, and if I look at it, the net debt just going up and up, so they have increased it by 2.6 billion without adding any value. Of course, again, management, acquisitions, let's pay a lot for something hot, let's dispose the things that are not going as we planned and improve our gross margin without really improving the business. Similar here, just not to overlap them, these businesses are priced in that line, European, let's say old brands businesses, US brands businesses, global, okay, fairly priced but low return for their risk. And the key risk is stagnation, P ratio of 10 on stagnation. You know where we get there. This is wrong. As I said, you read the two. EPS based on group share of net profit from recurring operations. If you add the yearly non-recurring charges, this is lower. P ratio of 12, the price can go to 60 in a bad environment. Diageo, same. If it goes, there is still 50% down, and then you can call that maybe a value investing or opportunity, depending also on other opportunities. It is very unlikely it will go down another 50%, maybe another 25%, depending on how the year goes. If their target is 7%, they do 0, the stock will suffer because of missed expectations, and then you might buy it for lower. But without a P ratio of 10, on those brands, given the competitiveness, etc., it's not simply value investing, and you are here for value investing. Thanks for watching. I'll see you in the next video.